How do you make money as an investor? The people who don't know think the way you do it is by buying good assets, a good building, stock in a good company, or something like that. That is not the secret for success. The secret for success in investing is buying things for less than they're worth. If you buy AAA bonds, there's only one way to go. AAA bonds are bonds that everybody thinks are great. Their companies are making a lot of money. They have prudent balance sheets. The outlook is good. Everything's perfect. So if everything's perfect, that means it can't get better. And if it can't get better, that means it can only get worse. It doesn't have to get worse. But if there is a change, it's going to be for the worse. And if you buy a high quality asset, but you overpay for it, you're in big trouble. And you can buy a very low quality asset, but if you pay less than it's worth, chances are you're going to make money. If I say to you, would you like to buy my car? What is the one question you must ask me before saying yes or no? Price. You get an A. You get an A. In order to consistently outperform as an investor, you have to have something that everybody else doesn't have. Came across a quote from Warren Buffett on Thursday, and he says, we pay a high price for certainty. In other words, when people are confident, asset prices escalate. That's a bad time to invest. The confident times feel like a good time to invest, but people who want to buy bargains should prefer uncertainty. Now everybody has a computer, everybody has information and data feeds, everybody's open to everything. The greatest of all the adages in this business, and I use a lot of them, is one I learned in the early 70s. What the wise man does in the beginning, the fool does in the end. Every trend in the investment world eventually gets overdone. You know, I have a son, and when he was in college and decided to become an investor, he used to come to me and he used to say, well, we should buy, let's say, Tesla, because they have this great new car that doesn't use any gasoline. My response to him was always the same. Who doesn't know that? There's nobody in the world who doesn't know that. Then that's not a reason to buy an investment, because if everybody knows it, it must be incorporated in the price.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. I mean, that's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading.
Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain, it's the stomach.
I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. If you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page, you should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. If you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear. If you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I saved all this money all my life and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%. No, people are reaching for yield. There's no question about that. And that's stupid. And it has consequences over time. But it's very human.